Hi, welcome to the Latino Tax Pro Tax Cuts and Jobs Act, as well as the 2018 Draft 1040. I'm Carlos Lopez. I'm the Executive Director of Latino Tax Pro, and my colleague Nick Young, enrolled agent, will take on the second half of the 2018 Draft 1040. Let's get started. So we're going to give you a summary overview. This isn't detailed. It's a 1-hour presentation. We're going to let you know what is changing, what is not changing, how is 2017 affected. We're going to let you know that this bill did pass on December 20th, 2017, and the president enacted it, signed it into law on December 22nd, 2017. An important part of this is the changes begin in tax year 2018. So what is changing? Well, most Americans will pay less tax until 2026. That's when all these changes come to an end. The 7 tax rates we currently have will be lowered. The standard deduction is nearly doubled. There are no more personal exemptions. However, you still need to input your exemptions, your dependents, because some states are not conforming and there may be some exemptions that you could be missing out on, as well as the child tax credit and some other credits. Most tax bills will drop, but it depends on your family size and what state you're in. And of course, it depends on the circumstances of each family. So what else is changing? The alimony deduction for 2018 has been eliminated unless you have entered into a prior agreement in a prior year, 2017, where you've already been paying alimony, and you need to make sure you have all that paperwork to substantiate your deduction. It'll exclude the income to the recipient, and it is not a deduction to the person paying it. And as I said a minute ago, it's only applicable to agreements executed or modified after December 31st, 2018. Casualty losses can only be deducted from a disaster declared by the president. The new act also expands the use of the 529 accounts. You can use up to $10,000 in tuition per student. You can use the 529 account for public, private, religious elementary, or secondary schools. This is new, very powerful. This is per student only, not per account. Here are some tax decreases we're going to talk about. It increases those who owe no taxes from 44% of the population to 47.5% of the population. Of course, as I said earlier, all these individual tax cuts go away after 2025 unless Congress does something. So these tax cuts for families are temporary. However, the reductions for businesses is permanent. And the theory behind that is businesses need permanent tax cuts to stay, or they may move. The corporate tax rate falls from 35% to 21%. And this is about $1 trillion tax cut over 10 years. The economists aren't sure if this will change the economy. It'll either be modest or it may surge. We'll find out. Beginning in 2019, there will be no requirement or mandate to buy health insurance. It is still there for businesses, though. If you have 50 or more equivalent full-time employees, you still must have health insurance for your employees or pay a penalty. Possibly up to 13 million fewer people will be covered in about 10 years. This does cut government spending by $300 billion. There are other changes planned, and those will be coming out as the IRS releases regulations and guidance. We need to be able to prevent medical insurance's cost from rising. The medical deduction floor is 7.5% for 2018 and 19, and then it goes back to 10%. Here's another big one, the child tax credit. It's for working class families. It's a bigger child tax credit. The current child tax credit is $1,000 per child. It now increases to $2,000 per child. It increases the eligibility up to $400,000 in earnings, a substantial increase from the prior floor. The refundable part of the credit is $1,400 per child. Don't qualify? There is a $500 family credit available. What about mixed status families? What if the parents have ITINs, and what if the children have Social Security numbers that are valid and living and born in the U.S.? We are waiting for guidance from the IRS. As soon as we get it, we will send it out. Let's talk about estate taxes. You can now pass on to your heirs up to $10 million tax-free. Currently, it's up to $5 million. The estate tax remains part of the tax code, even though the president wanted it eliminated. The good side of it is far fewer families will pay. My family, of course, doesn't have that problem, but it includes property, stocks, and other assets. Here is the other biggest part of this whole tax law change is the Code Section 199, capital A, Qualified Business Income Deduction, or the QBID. It is a 20% reduction in taxable income. Most American businesses are passed through. That means the income is passed through to owners. And the usual companies that qualify for this are the subchapter S corporations, limited liability companies, partnerships, sole proprietorships. We are waiting for IRS guidance to see how this new deduction is going to work. There are some other limitations depending if you're a doctor or a lawyer, but as I said, this is an overview, and our more expanded course has more information available on that, and as IRS guidance becomes available, we will release it. No more corporate alternative minimum tax. This is a huge relief to the business community. Because of AMT, if it's not difficult, it's impossible to reduce your tax bill. AMT makes tax credits disappear, and there's no incentive for corporations to grow if the AMT kicks in and corporations have to pay more taxes. Fewer families will have to pay individual AMT. You know, as you're preparing a tax return and you keep adding in deductions on the Schedule A, your taxes don't change. You're going to see a big difference this year. The AMT in the previous world prevented wealthy from tax dodging. It now affects families earning as little as $60,000. The threshold is now $500,000 or $1 million for married couples. Some may still pay, but much less. The mortgage interest deduction just got smaller if your loan on your home is over $750,000. Currently, up to $1 million worth of mortgage interest is deductible. New loans have a $750,000 cap, but there is a caveat. If you borrow up to $100,000, and this is, like I said, we need more guidance, you will be able to write off the loan if the proceeds are used for remodeling or for expanding your home. So it can't be a line of credit. The HELOCs, the home equity line of credits, that's what this part of the code is trying to eliminate. The sales and local taxes on Schedule A currently are unlimited. However, with the new law, they're limited to $10,000. That includes state withholding taxes, local taxes, property taxes, state income taxes, and sales taxes. Right now, the IRS is working on the new Schedule A to put these in order because depending on which tax you're going to deduct on your Schedule A, it depends on how you're going to treat your state taxes, because remember, state taxes are treated differently than other taxes. What is this going to cost us? Well, the final bill costs about $1.46 trillion over the next 10 years. That's an estimate. This, of course, does add to our national debt, which is about 23 trillion right now. What is not changing? The student loan deduction, medical expense deduction, graduate student tuition waivers, retirement accounts stay the same, 401s, IRAs, and Roth IRAs, charitable contributions, and capital gains is not changing very much. So, death and taxes, the two permanent things we have in life. These became law when signed in by the president. Our last tax reform was in 1986. So tax laws will change. You know that they change almost every year. Our mission here at Latino Tax Pro is an education mission. We're going to make sure that we keep you informed. Go to our website, latinotaxpro.org, and sign up for our free newsletter if you don't have it already. Thank you. I am now going to turn this over to my colleague, Nick Young, enrolled agent. He is our webinar director here at Latino Tax Pro, and he's going to talk about the draft 1040 and the new schedules. Turn it over to you, Nick.
Thanks, Carlos. Okay, the latest updates that we have received from the IRS is the new 1040. Let's, without further ado, take a look at the front page. Now, the first thing you may not be aware of is that they were given the mandate to create the 1040 as a postcard size. Now, I would say this is more like a 3x5 versus the little postcard size, but they wanted to keep it simpler. Now, I think as we go through this and as you look at it, you'll realize it's not necessarily simpler, but it is more compact and therefore easier perhaps to be able to fill out. Well, I'll let you be the judge at the end. The first thing to notice is that there is only a 1040. There is no longer going to be a 1040 EZ or a 1040A. And that part I have no problem with. Those were nice in the day many years ago when we would fill them out by hand. So for a single person with no dependents and utilizing strictly standard deduction, obviously they didn't need a complete 1040, and it was much quicker and easier to fill out a 1040 EZ. Now that we primarily 99.9% of all of us e-file our tax returns, it's not necessarily an issue to have a 1040 EZ or a 1040A. So in this case, no matter your filing status, no matter your deductions, standard or itemized, you will use Form 1040. Another issue to look at is the top right corner of the screen where you see married filing separate return, qualifying widower return, or head of household. Only those three filing statuses are showing up. Where is single? Where is married filing jointly? Well, the idea here is that if you, as a single person, enter your name, there it says your first name and initial, then last name and social security number. If that's all that's on there, then stand to reason you're single status. You wouldn't mark, and you don't mark even any one of those three boxes. Now, if you're married, then you would have your name and last name and social security number, and then spouse's name and social security number. Again, if either of the three boxes are checked, then that means you are married filing jointly. We feel personally that that's going to make it very confusing for a lot of people, and therefore we have put out the notice and request to the IRS to go ahead and have all five statuses up on that line so that then they can pick the correct one. Next, we have home address, city, state, and zip as normal. And notice on the far right now, presidential election campaign, there's the box for it, as well as full year health care coverage. This is where you check if you did have full year health care coverage. Now, to go back up, right between first name and spouse name is standard deduction, and of course right below spouse name, also standard deduction. Those check boxes. Someone can claim you as a dependent, that's what you check, or you were born before January 2nd, 1954, meaning you're 65 years of age, or you are blind. As either any one of those checks are in there, then that's naturally going to change your standard deduction. Going back down below the address is dependents. Now at this point there's only room for 2 dependents, and rightly so. We were talking to the IRS not too long ago, and the IRS was saying that most families, 2.3 kids is the average in this country. So in many cases, mine included, there is enough room for my dependents. I have actually 1 now. I used to have 2 until my older son moved out and is on his own. So if there are more, then naturally the software is going to have a way for you to add more. We suggested to the IRS that if there is room, if you can make the room, to at least put 3 in there so that, again, that will cover most families out there. But I have many clients who have more than 3, so again, just have the additional page, or as the software allows you to enter it more, and then it'll print out. But there it shows, first name, last name, social security number, relationship to you, and then the 2 boxes, child tax credit and then credit for other dependents. You wouldn't have them both checked for one dependent, but the credit for other dependents is the $500 credit for your dependents that are 17 or older. So that could include parents. But again, they must live with you and must have valid social security numbers, just as the child tax credit now requires valid social security numbers. And this is, again, the top page of the 1040. It's a postcard size. There you sign, put your IP PIN if you have one, and of course a place for the paid preparer to enter his information. Now if you go to the back side of the Form 1040, still postcard size, and we're concerned too, as we've spoken to the IRS, that people are going to think it's postcard size, so I can just mail it like a postcard. And we certainly want clients to understand that's not a very good way to send in your tax return, because of course privacy issues and someone getting your personal information, let alone there's no place for an address to mail it to. You really want to be sure to put that in an envelope. But the back side of the Form 1040, I'm going to miss personally line 7. That was where we knew to put in information for W-2 wages. Now it's line 1. There is no more line 7. So line 1 is going to be wages, salaries, tips, where that's the old line 7. Attach the forms W-2. Lines 2 and 3 are your interest and dividends. Lines 4 and 5 are your IRAs and pensions and Social Security benefits. Beyond that, line 6 is additional income and adjustments to income. So the new Form 1040 may be more compact and on a postcard size, but it's still all the same reporting requirements. And so how do we do that? Well, there is still Schedule A, and then Schedule C, D, E, and F, but now there's also Schedules 1, 2, 3, 4, 5, and 6. So the first one we're going to look at is line 6 there, additional income and adjustments to income, attach Schedule 1. And here is Schedule 1. Now we still like to stress to everybody who's looking at this that these are all still draft. So there could be major changes to what is actually going to end up being. My personal professional opinion is, since they had the Tax Cuts and Jobs Act, huge change in the tax code for this year, why are they also changing? I guess they just want to hit everybody at once with all the changes and let them get used to it. My personal feeling is they should wait a couple years before maybe changing the actual forms. On the other hand, if they're going to do it, I guess just do it all and get it over with. So here's Schedule 1, additional income and adjustments to income. This is what used to be on the front page of the 1040. So you see additional income, taxable refunds, line 10. Line 11, alimony receipt. Remember, that's still for 2018 and then won't necessarily affect in 2019. There's line 12, as usual, for business income, Schedule C. Line 13, capital gains or loss, attached Schedule D. Line 14. And the reserved, if you see, like 1 through 9B reserve, 15 and 16 reserve, those are the lines that are now showing on the 1040. And they were line 1 and 2 and 3 and 4. So that's why they're still in here, but showing reserve. Line 17, still Schedule E. Line 18, Schedule F. There's unemployment, compensation. 20 is not because Social Security is on the 1040. And there is still line 21 for other income. And again, a whole lot of items that would fall under line 21, other income. Total them up. There's your total income, line 22, and then adjustments to income, and they're predominantly on there. The only one you're going to really not use this year going forward is the moving expenses, line 26, unless you're a member of the armed forces. Otherwise, moving expenses are no longer a deduction. Still getting to line 37 for your AGI, or adjusted gross income. But notice line 37 doesn't call it AGI because you take that amount and then you go back to the 1040 and now put that on line 6, and now combine lines 1 through 6, and line 7 is now AGI. So there's your AGI, no longer line 37. Line 8, enter the standard deduction, otherwise attached Schedule A. So it's still standard or Schedule A itemized deductions. I've had many clients that tell me, well, I think itemized deductions is going away. It's not going away. You still can itemize. You may be in the situation like I am, in that for last year my itemized deductions were about $18,000. So certainly I itemized versus the standard deduction last year of $12,700. Now this year my itemized deductions should be about the same, but standard deduction is bumping up to $24,000 for married filing jointly. So naturally I'm not going to itemize. So it's not that I can't, it's just not as good a deduction as the new standard. Line 9, qualified business income deduction, the QBI, that we talked about earlier in this presentation, and you'll see more information as you attend some of our webinars and conferences. Also, line 10 then is taxable income. So you subtract line 10, and then line 11 is your tax. And look, there is another Schedule 2. Let's look at Schedule 2. This is showing the tax 38 through 43 reserved. That's your withholdings if you're using a W-2 or any estimated payments you made. Then line 44 is your tax, usually from the tax tables, but it can include child's unearned income tax, tax on lump sum distributions, other taxes. There's line 45, AMT still applies, but a much broader range. Most people will not have to do and pay AMT. There's the line for the excess advance premium tax credit. So if you paid too much into your premiums under the Affordable Care Act, then this is where you're going to pay it back to the IRS. Total tax then, line 47, comes back over there on line 11. Line 12, if you're only non-refundable credit. So this is where we start on the old 1040 page 2. Non-refundable credits. So you got to have tax to take these credits. You owe no tax, you don't have any credits. So if your only non-refundable credit is the child tax credit, or as we're calling it, the family tax credit, then you just put that in line 12. Otherwise, if you have other credits, such as earned income tax credit, you would need to attach Schedule 3. And here is Schedule 3. Foreign tax credit still on there. Credit for child and dependent care expenses, still Form 2441. So as you can see, all the forms required to report and receive the proper credits need to be reported on their forms and still need to be attached to everything. There's the education credits, Form 8863, retirement savings contributions credit, Form 8880, child tax credit, credit for other dependents. So if you're including the child tax credit and the credit for other dependents along with other credits, then you would report it on this Schedule 3 and not separately on the 1040. Residential energy credit, general business credit, and additional credits that may apply may come up at the last minute that we can put on here. Total non-refundable credits, enter here and on Form 1040 line 12. There we go back to line 12. Line 13, you subtract, and in line 14, there's other taxes, and we have another schedule, Schedule 4. So this is where you would do Schedule C, still for self-employment, sole proprietors, and then of course you have self-employment tax that you need to pay into your system. Also, and then so it continues down, Social Security and Medicare tax on tip income. Line 59, the additional tax on IRAs. If you pull money out of your 401k before you're 59 and a half and you pay that additional 10% penalty, this is where that goes. Line 60A, household employment taxes. There is line 61, it's still on there, health care, individual responsibility. So if you remember in 2018, if you did not have the minimum essential coverage for health insurance, whether Affordable Care Act or any place else, if you did not have it for yourself and anybody else on the family, there is still the penalty that'll be approximately $700 per person. So that's where that'll show up here on line 61. Oh, by the way, there is still line 60A for it's line 60B for repayment of the first-time home buyer credit. So that continues to be for those who received that credit back in 2008. Altogether then, line 64, total other taxes. That comes back over here to line 14. Line 15 then is total tax. Line 16, there's where you have your federal income tax withheld, what we called payments before. And now line 17 are the refundable credits. Earned income credit. Look at the instructions. That's where the dollar amount goes. Schedule 8812 for additional child tax credit. And Form 8863 for the refundable portion of the American Opportunity Tax Credit. If you have any other payments or refundable credits, Schedule 5. And so here, you're not putting in those others. You do count them separately, the Earned Income Tax Credit, Child Tax Credit, and the Affordable American Opportunity Tax Credit, refundable. So that's why you see all the reserved on there. So there's still a place to put in your estimated tax payments and amount. There's if you actually did not pay enough into your premiums and you should have had a greater amount, then line 70 is your net premium tax credit. And then of course 71 if you're wanting to pay with a request for extension to file. Line 72, excess Social Security and Tier 1 tax withheld. Credit for federal tax on fuels. That'll be interesting to see what that is. And going on down, then line 75 is your total other payments. And that goes there on line 18. And you notice line 18, add line 16, 17A through D, and then these are your total payments. Then refund, if you have more withheld than what you owe, then of course you're getting a refund and that continues to be the way, or if there's amount you owe. Now one other form it's not showing here is the Schedule 6. And Schedule 6 is just the form where you would enter a foreign address if you have one, and a place to fill out the information for the third-party designee, which we know mostly is us as the tax preparers. Personal information, you put it there, or business, I should say, information goes there. Now here's a quick look at the new Schedule A, itemized deductions. Now this particular, we liked this model because there is an actual draft form out that shows that it's not 10% for medical and dental, but the 7.5% in 2018. And we're going to go down there, that's the number one, and then taxes you pay, number two. The new draft form of the Schedule A will show where it gets to line 9, but it says capped at 10,000. So if it's under 10,000, of course, you will put that amount. If it's 10,000 or more, then you will just cap it at 10,000 and no more. Interest you paid, your mortgage interest deduction may be limited. Again, we talked about that with the cap of $750,000 for mortgage on the amount of the property, the borrowing of the property, money, mortgage, liens. And so if you can have it more than, if the value of the property is more than $750,000, you can only deduct interest on the $750,000. There's your donations to charity. The big change on that is only that you can now donate up to 60% of your total income, not just 50%. Casualty and theft losses has been drastically changed to where it's only for federal disaster areas declared by the president. The next section is really going to be gone away. There won't even exist on the draft form. It's not even on there, and that's the job expenses and certain miscellaneous deductions and our familiar Form 2106 that no longer applies. So down at the bottom, total itemized deductions, there will be no limitation on your itemized deductions. The key for most people is, will the itemized deductions be more or less than the new standard? One other new form, draft form we've seen, is the additional child tax credit. And one of the key changes is Part 1. Last year's, if you look back at the additional child tax credit form, Part 1 would ask for any qualifying dependent who has an I-10, do they meet the substantiation test, which means did they live with you, the substantial presence test. So did they live with you for the year? They could not have an I-10 and be out of the country or live somewhere else. They must have lived with you for the entire year. And so it was specifically asking for any qualifying dependent who has an I-10 that the substantial presence test was met, which means they lived with you. That's gone. There is no more of that, because anybody qualifying for the additional child tax credit as well as the regular child tax credit must have a valid Social Security number. That's the big change for our clients. The key that we haven't had total guidance yet is on the status of the parents. It doesn't specify if the parents have to have a valid social or if they can continue with an I-10. It only addresses for the qualifying child. They must have a valid Social Security number.